Welcome to the Schultze Asset Management Investor Webinar for the final quarter of 2021. We're all so happy to have you join us while we talk about updates to our firm and the fund. My name is Angela Louie, and I am the Head of Business Development at Schultze Asset Management. And today we will talk about how we've generated returns in the past quarter and year. As we enter a new market cycle, we want to answer the question, in what new ways are we thinking about our portfolio construction? We talk about the implications of more volatility and why we are excited for this new environment. And here to talk about all of that is George Schultze, founder and managing member at Schultze Asset Management. Okay, so this webinar is for investors only. If you are press or media, sign off now and contact us directly at investorrelations@samco.net. Give me a few seconds and I will share the presentation on the screen. This presentation is a summary of our views. On Monday, February 14th, the Schultze Asset Management 2021 Q4 report was sent to you. So we ask that you please read that for a more detailed and expanded description of our view. We have an hour together, and in that time, we will cover a market review of our last quarter and the outlook for 2022. Together, we'll also look at how we are living the consequences of very aggressive governmental support and what this means for distressed trends. George will walk us through some of the trades that have moved the portfolio in big ways and talk about why inflation changes the way he sees opportunities. What will happen for the rest of this year, and where do we expect investment opportunities to be? So we will be talking all about that. We will also have an opportunity to interact directly with you at the end during the Q&A section. So please queue up your questions and type them into the Q&A box at the bottom of your screen. We will do a little something different this time. And if you'd like to ask the questions yourself in your voice, please type the word live and I will unmute you and you can ask the questions that way. All right. So let's begin with returns. Our fund generated a net return of plus 19% in 2021. Now, if we open up the hood to look a little deeper, the liquid portion of the portfolio returned a net plus 62%. Taking a step back, broad equity indices were up for the year. The Russell 2000 returned plus 14%, and the S&P 500 was up 27% for 2021. For the fourth quarter, the fund's net performance was down 9%. The liquid portion of that portfolio was up 8% for the quarter. In comparison, the Russell 2000 and the S&P 500 were both up 11% for the quarter. We are entering into a new monetary tightening cycle with the Fed telegraphing its intent to raise rates to combat inflation. However, the Fed is still purchasing assets. It will buy $30 billion this month before winding down its monthly purchases in March next month. Economists don't expect the Fed to reduce the size of its balance sheets rapidly. Rather, most of them are expecting the Fed to eventually announce plans to just let fixed income securities mature without replacing them. On the fiscal policy side, it is also remaining expansionary, given the recent passage of Biden's infrastructure bill and the continuing of deficit government spending. This may be somewhat offset by the tax rates climb, especially since the 2017 tax rate reductions are going to begin expiring in the next 12 to 24 months. For those people on the call that know us and know our focus, you will know that we look for unconventional ideas that drive our returns. Our investments will be event-driven in nature with catalysts that are uncorrelated with the markets. We embed hedges into our portfolio to protect against the market inflation and also the ever-heightening inflation risk. And we manage risk by adhering to our process, which is a strong focus on fundamental analysis, limiting our leverage, and also having appropriate position sizing and adhering to stop losses. We closed our second SPAC in the fourth quarter, and George is excited to talk more about that in just a moment. So let's talk a little bit about what happened last year and what's going on this year. Let's go through some macro numbers first. Real GDP is at 6.9%, unemployment at 4%, inflation at 7.5%, and the Fed funds rate at 0.3%. Okay, so where does that leave us? Monetary and fiscal policies remain expansionary. We expect the Fed to raise the Fed fund about 4 to 5 times in around 25 basis points increments each. If that is the case, the resulting 1.25 to 1.5% rate would still represent a very accommodative monetary policy compared to the long-term average, which is approximately 4.95%. Because the interest rates are and remain low, this will spur further inflation. The infrastructure bill passing, deficit spending, may be somewhat offset by the tax rates climbing, but fiscal policy still remains very expansionary. Early this year, we saw increased stock market volatility in response to news that we are entering a new monetary cycle. We believe that stock market correction was overdone and thusly created some interesting new buying opportunities, and we forecast elevated inflation risk. We maintain hyper focus on finding on searching out for absolute returns. We are smartly utilizing conviction-based shorts on companies that's facing Chapter 11, and our long positions average 3.95 times multiple enterprise value compared to the 14.2 times from the S&P 500. Risk management is a big part of what we do, and we do that by focusing on, again, fundamental analysis, limiting our leverage, and thinking through appropriately sizing our positions while exercising our stop losses. Again, all of our trades that we put on, we think through how we can embed hedges against market corrections and inflation. And this is a great place for me to stop. George Schulze, founder of the firm and the managing member, will talk about default trends, our portfolio highlights, and some of the big mover names in our portfolio. Just a brief background, George chairs our investment and strategy committees. Before founding this firm, he worked at MD SAS, Fiduciary Partners, a fund of fund, and at Mayer, Brown and Platt Law Firm and Merrill Lynch. I'd like to remind you that if you have any questions, please type them into the Q&A box at any time, and we'll get to them at the end of the presentation. And if you would like to ask them in your own voice, type the word live in front of the question, and I will unmute you. Hi, George.
Hi, Angela. Thanks for that. And thank you, ladies and gentlemen, for your attention this morning. I believe we have people dialing in from all around the world, so good thing that we have the Zoom functionality to do this. So just turning to page 5 here, the default rate. This is the long-term range of defaults as tracked by JP Morgan. You can see here on this chart, clearly default rates are down. And it's really a result of just massive fiscal and monetary stimulus in response to the pandemic. So defaults have plunged. Right now, you can see there the high yield bond default rate is below 0.3%, and the loan default rate, which is junk rated loans or leverage loans, whatever you want to call them, is 0.48%. And that's way below the long-term averages of 3.5% and 3% for both of those. So, big contrast versus last year when defaults surged due to the COVID-related shutdowns. And you're seeing it really in the amount of distressed debt supply out there. Last year, only 13 companies defaulted on 13 billion in bonds in total and loans, versus 109 companies the year before in 2020 on 141 billion dollars in loans and bonds. So I think the most interesting takeaway from this slide is really that when default rates are dropping or are sustained at low levels, usually that represents the best opportunity in the marketplace for buying post-distress equities, as we call them. And you can find those both in the public domain, we call them post-reorg equities or listed securities, very often value-oriented plays or value investments, and also in the private market. And that's one of the reasons we have launched our second SPAC to take advantage of those private post-distress opportunities. Usually these stocks, they have event-driven returns that can be uncorrelated with the market, and that's why we like them. And those events are things like stock buybacks, special dividends, and even M&A transactions when the capital markets are open like they are right now, which can drive those securities closer to fair value. Looking at the industries and themes where we see interesting opportunities right now in distressed investing. In the airline department, you're seeing some M&A transactions now. There have been some announcements recently. In the auto manufacturing domain, lots of activity. There's supply constraints. So you have a massive chip shortage, and that's impacting all of the automakers. But companies like GM and Stellantis, which is a post-fiat merger entity, and even Tesla, they're all impacted by secular change and supply constraints. And it's interesting how that's causing sort of haves and have-nots among companies in that space. In the casino space, interesting development with secular change. More and more companies are going into the online betting space, and one that's in our portfolio that's doing just that is Caesars, and that's positioned quite well as a post-reorg equity. In the coal space, that's an interesting one because it's such an interesting inflation play, especially the met coal industry, which is metallurgical coal. We'll talk about that in a minute. Energy, I think the main focus there is oil and gas producers. And the takeaway with that space is that peak oil demand is still many years away. And there was a recent Forbes article that I wrote that makes that case. You can also see that in our last monthly letter. But coming out of the crisis of the dual demand and supply shocks in the year 2000, when you had COVID setting in and the price of oil temporarily going negative, there were lots of companies in the oil and gas space that went bankrupt. And the ones that restructured during the worst of times really have now positioned to be the best companies on a post-reorg basis. And some of those companies that we currently hold in our portfolio are names like Chesapeake, a massive natural gas producer, and Whiting Petroleum, a nice oil producer. Both of them are very interesting post-reorg equities that are extremely cheap still, even after having appreciated a lot in the last year. On the financial services space, we'll talk about MBIA in a minute, but there's also some opportunity here with large banks, companies like Bank of America that were very distressed during the great financial crisis, but continue to be generating an increasing amount of net interest income now and are getting closer to fair value. Turning to governments, Puerto Rico, the largest municipal bankruptcy of all time, is now winding its way through the conclusion of its bankruptcy. And that actually directly impacts MBIA. We'll talk about that in a moment. Stepping down to more litigation, I think that's really one of our firm's specialties and sort of ground zero right now for litigation-related disputes that cause bankruptcy is companies that have opioid exposure. These are the pharmaceutical companies that produced opioids, and several of which are now in bankruptcy or winding their way through bankruptcy, like Purdue Pharma, Mallinckrodt, and then a few that like Endo and Teva and Johnson & Johnson that haven't really filed for bankruptcy but have some risk of that. In real estate, we've got some new opportunities with the China construction bubble finally collapsing and some Chinese developers facing massive new distress, some very large companies over there. There's some new interesting opportunities developing in that space. And then I guess just a couple last words on this page in terms of the last two sectors, telecommunications and utilities. In the telecommunications space, some interesting post-reorg equities, public and private, like Frontier Telecom, and then on the private side, Windstream, and again on the public side, Unity, which is a REIT that owns telecom infrastructure. And finally, in the utility space, really interesting developments over the last few years here with extreme weather like wildfires or inadequate infrastructure like you saw with the Texas storms has caused some interesting opportunities in post-distress equities, companies like Vistra and Pacific Gas and Electric, both positions in our portfolio. So let's go through some of the portfolio highlights, please, on the next page. So as Angela just mentioned, we had a good gain in 2021, nearly 20% on a consolidated basis. If you look only at the liquid pool, it was a whopping 62% net. And you can see the index figures here as well, both for the year and quarterly. For the final quarter of the year, we were proud of our win-loss ratio, which was as high as 6.3% if you exclude a liquid. So liquids, of course, were unable to be sold during the quarter. On the short side, we had a less impressive 0.1 times win-loss ratio for positions that made versus lost profit, mostly due to Endo Pharmaceuticals, which was a short that we covered as it appreciated, really without much change in fundamentals. We grew our distressed debt book at the end of the year up to 6% of NAV. I expect that in the next year or two that will grow more. For now, our post-distress equities book is still our main focus at 115% of NAV. And our short sold book right now is at about 4% of NAV. I think this will grow before our distressed debt book grows, because that's how it typically works with us in a cycle, in a market cycle. Remember, we have three different trades. We short sell companies headed into bankruptcy. Usually they're pre-petition equity holders see 100% loss when a company goes through bankruptcy, or they're substantially diluted, one or the other. And that's a unique trade. Most big funds can't do that because it's capacity constrained. Then when distress really hits, we tend to focus more on distressed debt, where we can create the fulcrum security, if you will, the new equity at a reasonable price through the old debt. And then later, in the tail end of the cycle, like we have right now, that's usually the best opportunity for post-distress equities and for getting out of them as you get these event-driven type catalysts, like I mentioned earlier. Angela already mentioned before, our portfolio is very cheap right now, 3.95 times. I would encourage any investor to consider that if they have capital to allocate. You'd really be buying in at a smart price right now. On the short side, our portfolio is extremely expensive at over 113 times EBITDA. And that compares very favorably with the broad equity indices. You can see here the S&P is at about 14 times EBITDA. So think of our fund as a nice complement to your existing portfolio, and something that will probably zig when others zag and hopefully do well over a long market cycle. So just a couple words about our best performers and worst performers, and there is more detail about these in our quarterly letter. The top three positions in our fund during the final quarter of last year were Alpha Metallurgical, General Motors, and MBIA, and our worst performers were Clever Leaves, Endo International, and iHeartMedia. We'll talk about a couple of these in the next few pages. Let's turn to Alpha Met first. So we're trying to get faster and faster in terms of reporting our earnings to our investors. And as a result, sometimes our earnings webinar, like this one, come out a few days before all companies have reported. So Alpha hasn't reported its year-end results yet, but the theme is very obvious. I don't think there'll be that much change when they do report earnings. But this position is a 13% portfolio weight for us. It's a long post-distress stock position that generated an IRR of 23% in the fourth quarter. It's a met coal producer, has operations in Virginia and West Virginia. And as a met coal producer, it makes coal that's used to make steel. It's a crucial feedstock for steel making. And it's really a pure play operator. It changed. It used to also produce steam coal, which is burned to generate electricity. Not so environmentally friendly on that side, but Alpha has evolved and gotten away from that side of the business entirely now. So it's one of the only pure play operators on the US markets, and it's the largest one. It restructured in 2016, and when it came out of bankruptcy, it eliminated almost $8 billion in debt. So it has a pristine balance sheet right now. And this is kind of unusual, it also has substantial tax assets, almost $2 billion of NOLs and other tax assets, which help shield AlphaMet from having to pay cash taxes for many years going forward. In the last quarter, and I'm sure there'll be updates in a couple of days when they announce earnings, but in the last quarter, they reduced costs by about $20 a ton, and they had replaced some high-cost mines with lower-cost alternatives. They also reduced long-term debt and legacy liabilities by over 75 million in the last quarter. And they also have, they put out some preliminary financial guidance for this year, and it looks good. Right now, AMR trades at about 2.1 times enterprise value to EBITDA. Just looking at yesterday's close, it closed at about $85 a share. Our target is about $140 per share for AlphaMet, and that would represent 65% more appreciation. So let's talk about Clever Leaves. This was our worst performer during the quarter. About a 14% weight between the various different positions we have in the fund and different securities we own. Unfortunately, it was a 62% loss during Q4. And we were obviously disappointed, but we took several steps after the year end, which we believe will increase our likelihood of success with Clever Leaves going forward. Just by way of background, for those of you who don't remember, Clever Leaves is a disruptive, low-cost, multinational provider of high-quality, pharmaceutical-grade cannabis for medical use. They don't sell cannabis for recreational use. And for those of you who know individuals who may have or had cancer, it's becoming, a more increasingly and well, accepted method of treating pain related to cancer. In December of 2020, our prior SPAC vehicle, call it SPAC number 1, merged with Clever Leaves and brought it public and listed it on the New York Stock Exchange thereby. So its ticker symbol is CLVR. Since the end of last month, actually, there have been several notable developments with Clever Leaves. One, I was elected to the board of directors, and I'm joining Gary Julian there, my partner on the board. I fill a vacancy that was created there to be one of the new independent directors. The company also pre-announced their quarter results, which were in line with prior updated guidance, and they also gave guidance for 2022 of 20 to 25 million in revenues, which would be a 30 to 62% increase from trend. Finally, a leadership change with Clever Leaves. The CEO was replaced by the president and co-founder of the business, Andres Fajardo, who's great, and he's really the right leader to press forward for this company as it continues to develop commercialization of its product. And we think that this activist investment or activist involvement with Clever Leaves will ultimately help the company, succeed going forward and hopefully yield better results for our investment. So just to be clear, though, with 2 of us on the board, we clearly have insider status, and as a result, our fund is temporarily restricted from transacting in any Clever Leaves securities, and because of that, we're going to have to maintain them in a side pocket for some additional time. But we think that the trade-off of this between liquidity on the short term versus future potential success will be well worth the wait. So right now, Clever Leaves is trading at about $1.50 a share, and we think, I personally think it's worth many multiples of that. But we will let the market decide as the company continues to execute going forward. So staying on this page, but turning the leaf to a new investment, in the fourth quarter of last year, we also announced and completed the IPO of our second SPAC vehicle called Schulte Special Purpose Acquisition Corp. 2. And that was listed on NASDAQ as well, under ticker SAMA, and we raised $165 million for that second SPAC deal. Some differences versus SPAC number 1, we upgraded our underwriters for SPAC number 2. In this case, we used Stifel and Mizuho as joint book runners. And we're proud to report also that Stifel invested into our SPAC sponsor in this deal. And to my knowledge, it's their first time they had done that. So it was really a good show of faith and commitment by our underwriter to be invested with us. And we also, as a separate matter, we upgraded our team of SPAC advisory board members, and we have now 5 with expertise in a variety of different industries. So we're excited about that change as well. So just like SPAC number 1, the risk capital for SPAC number 2 was mostly sourced from our fund, and that formed a new side pocket. And we believe over time that should do quite well for our fund's investors. So we look forward to updating you on our progress with this. Obviously, for both Clever Leaves and SPAC number 2, there's nothing really I can tell you that's not in the public domain because both of these are publicly traded securities. But I guess I would conclude on this page just by saying that I'm excited about the outlook for both and look forward to reporting on developments for both going forward. Let's turn to General Motors. Post-distress equity in the portfolio, about a 10% portfolio weight, did well during the fourth quarter with a 13% IRR. Most investors know GM, one of the world's largest automakers. At one point, it had sort of a bad name when it went through bankruptcy and distress. People were calling it Government Motors for a while. But after it came out of bankruptcy in 2010, it succeeded in eliminating over $60 billion in liabilities subject to compromise. And that was one of the largest bankruptcies of all time. Also, through that process, which can be very powerful, using the courts to restructure your debt. I mean, you don't want to do it all the time. You probably only want to do it once if you ever have to. But if you're there, it's a good crisis to take advantage of the tools you have. And GM used those tools very well. They rid themselves of numerous unprofitable business lines. They closed certain dealerships and got out of contracts that were just unprofitable. And many people don't understand how that changed. But in reality, under the hood, as it were, with GM, this business was transformed through that process and with the management team after reorganization from an old line internal combustion engine manufacturing company, or ICE, to really now a new economy business. They've cleaned up their balance sheet through the restructuring, and now they've recently committed to invest over $35 billion in new electric and autonomously driven automobile manufacturing plants. So it's really an exciting story, and it's not fully there yet. GM stock's trading at about 50 now. We think it's worth a lot more. My target is about $95 a share, which would be 90% appreciation from where it's currently trading. But they've announced all these new developments, and interestingly now, as a new economy company, they present at the Consumer Electronics Show. And here are some of the recent announcements that they've made. They've added Walmart as a new customer for their Bright Drop vans. They've added new reservations by FedEx for the same new vans. And then GM Cruise, which is the only driverless company operating in San Francisco, they're offering the public rides for this new drive-hailing venture. Super Cruise is available on their Lyric now, and it will be available in 22 more models starting in 2023. And Ultra Cruise, which is door-to-door hands-free driving, will be available in the Cadillac Celestiq in the first half of this year. And then, of course, they recently announced the all-electric new Silverado pickup truck. For those of you who have time or interest, it's really interesting that that GM has this new Ultium platform, which some people call like a battery skateboard, and it forms the underbelly of all their new EV launches. They're really doing it the right way by having a uniform platform that can be used in multiple different brand launches. And they have 30 planned, over 30, between now and 2025. For the fourth quarter, they had record results, really due to pricing and mix, and were able to do that even though the chip shortage caused them to produce lower volumes. Also, used car prices are helping them in their GM Financial business. So just an extremely cheap company. As I said, there's about 90% potential appreciation left in the stock, so we like it. We think there's good upside opportunities still with GM. So I talked about MBIA briefly before. This is a long post-distress stock position for us as well. It's currently an 8% portfolio weight and generated a pretty nice 23% IRR during the fourth quarter. This company used to be the largest municipal bond insurer before it had so much success that it diversified into derivatives and ultimately became distressed. Now, MBIA's operating subsidiaries are in runoff mode, which means they're not writing any new insurance business. They're just working down their existing insurance contracts. And as that process resolves, they'll be able to eventually pay out shareholder dividends. So there are two primary operating subsidiaries. One is their profitable municipal finance insurance business, and that's managed through a subsidiary called National Public Finance. And then they have the legacy derivatives business. I call it the good side and the bad side. The bad side is operated through MBIA Insurance subsidiary. So MBIA's derivatives portfolio collapsed, some would say spectacularly, during the 2007 financial crisis. The company had gotten into insuring CDOs, selling credit default swaps, and really getting way over their skis. And as a result, they defaulted and had major losses. But then a couple of years later, in 2009, the company successfully ring-fenced their troubled structured finance subsidiary and moved their profitable muni business over to the new national subsidiary. And that's really where you should focus if you take a look at MBIA. The National Public Finance subsidiary is primarily, the team there is focused on remediation of its existing insured portfolio, which is 37 billion gross par amount outstanding as of year end. And the primary risks there, I mean, they have lots of different municipalities that they insure, but the primary risks that are troubled are those issued by Puerto Rico. That's 5% of their portfolio as of last quarter. As of the September 30th quarter, and represents 1.9 billion total amount. So the exposures there are PREPA, which is the local utility, PRHTA, which is the Puerto Rican Highway and Transportation Authority, and then GO, which is the general obligation bonds, just for the municipality, not for any targeted purpose, and then PBA. So 4 of those credits are currently in bankruptcy, but GO has just received court approval a few weeks ago to exit bankruptcy. And that process is underway. We expect that it'll eventually emerge from bankruptcy in the next few weeks, actually. And therein lies the opportunity with MBIA. The company's adjusted book value per share is almost $34, which is 250% higher than the trading price of MBIA, which was 13.46 when this was printed a few days ago. Now it's $15 or so. That target, getting to there from where MBIA is currently trading, represents a potential return of 120%. Now, management likes it too. Management has bought back 80% of the stock, and they've really guided the market to expect future dividends and liquidating dividends when this process is closer to complete. But we're getting very close now. Cofina has already restructured. PREPA is close, and GO is about to be resolved. So we think probably later this year you'll hear some interesting news about potential special dividends coming out from MBIA that should drive its stock even closer to fair value. So with that, let me turn it back to Angela and to conclude, and hope to answer whatever questions anybody may have. Thank you for your time.
Thank you, George. So here are some highlights. The fund performed well in 2021, returning a net 19% for the year. And the liquid portion of the fund returned a positive 62%. In the last quarter, the fund was net down 9%, and the liquid portion of the fund was net up 8%. The Russell 2000 and the S&P 500 indices were both up 14% that same quarter. We did very well last year, and the portfolio remains very attractive. New names are being entered into the portfolio to take advantage of this new market cycle we just described. In the changing landscape with more volatility, we recommend having a disciplined focus to search for absolute returns among unconventional ideas. We're happy to be celebrating our 24th anniversary of the firm with some of our longtime investors who are on this call today. What we'll do now is take some time now to answer some of your questions, and I'm going to bring George back on. Hi, George.
Hi, can you hear me?
Yes, terrific. So George, I'm collating the questions that are coming in, and I think this is a good time to start with this first question, which is you spoke about the heightened risk of inflation in this new cycle. What asset classes benefit from that?
Yeah, good question. Inflation, I mean, that doesn't seem to me to be going away anytime soon, no matter what you hear from the Fed. Maybe think of the Fed as stuck between a rock and a hard place, or behind the ball, as we said in our quarterly letter. They will be raising rates, and it's actually between our first draft of writing the quarterly letter, we expected it to be to 4 to 5 times this year. So now it's 5 to 7 times this year, probably in 25%, 0.25% increments. So that's the news on how you deal with inflation. The bad news is that it's probably not going to be enough. And the Fed has a massive balance sheet, and they really risk causing serious turmoil in unwinding that balance sheet. So I think they're going to be slow about it. And even if they raise rates 7 times, as I just said, in 0.25% increments, you're still going to be in an extremely accommodative monetary position. And as Angela said earlier too, you still have fiscal accommodation going on as well. The politicians are spending more than they take in. And so we're going to see inflation. And that's the bad news for all you investors, especially those living on fixed income or that have savings. I think the best way to deal with this is be long commodity companies. We talked about some in this deck. I like metals. I like met coal. I like natural gas and oil producers. Companies in those spaces that have clean balance sheets like the ones we discussed, with an interesting event-driven catalyst, will probably generate more gains for you, not just in the equity market, but certainly higher than inflation. And I also like gold and silver. I think having some of these sort of inflationary hedges makes sense. On the other hand, you could also short sell long-dated treasuries. I think that's probably a good trade too. Some people buy tips. I'm not really a big fan of that. I think anything that the government controls in terms of measuring, including CPI for calculating tips, might be subject to hanky-panky.
That's a great response. We spoke a lot about the macro environment when we first started our webinar. So the question is this: what does that have to do with your process of fundamental analysis?
That's a good question. Maybe to answer it, Angela, if you could turn back to the default rate slide. I don't know if you can do that at this point. If not, people can look at it on their own. But what I think you see with the long-term default rate. Oh, thanks. So you got it there. Yeah, I think this picture helps really set the table for thinking about the macro environment. And we try to also give a couple key performance indicators for the economy, not just economic growth, but also inflation and current interest rates and where things are going. But this shows it pretty nicely visually over a longer period of time. You can see times that you have high default rates. They usually correspond with a tightening cycle or some other exogenous shock that got us there. And when you see dropping default rates or steadily low default rates, those are usually better times where you have growth and looser monetary policy. So I think if you think of the world that way, we're clearly, and the Fed has said that we're clearly in a new tightening cycle. But as we just said, and as our team is interpreting here at Schultze Asset Management, it's going to be a slow tighten, and they're not going to try to kill the goose that laid the golden egg. So you're still going to see growth, but in terms of how to position yourself in this macro environment. If you have 3 trades like we do, the best opportunity for short selling companies is usually when default rates are rising. The best opportunity for buying distressed debt is when default rates have peaked. And the best opportunity for equities and post-reorg equities is when they're low or sustained low over a period of time or dropping. And I think that's where we are right now. And I think that's how our portfolio is positioned really the right way right now. We're overweight that extremely cheap post-reorg equity bucket, but we're nimble and ready to short sell companies as they face distress, especially in this new tightening cycle. So I think that's, and that's what our team has actually talked about in our portfolio meetings. We're starting to look for more short ideas. We're cognizant of and looking for new distressed ideas, but the picking there is kind of slim. There are some good opportunities in opioid companies, because some of them are extreme value investments as they settle their litigation. And some of these Chinese developers look interesting, but it's hard to get extreme conviction with those companies just because of where they operate and how the rules are different over there. But that's where I think we are, and I think hopefully that answers the question about fundamental analysis for you.
Terrific. I'm going to try to do this, and let's see if it works. We have someone that I think is trying to ask a question directly. So Michael, give me a moment and I will try to unmute you. Michael, are you with us?
I hope so. Do you hear me?
We
Hi,
hear
Michael.
you very
How are
clearly.
you?
Hi.
Hi, George. We've both been around the track quite a bit. What is your estimate of the institutional size that is in distressed securities? Your other 2 prongs, I don't think have a lot of institutional money in it in a limited portfolio.
Mm-hmm.
And what do you think is the rate of change?
Yeah, so I do think the amount of institutional capital in long-only distressed debt funds, it probably peaked, late after, the big COVID year in 2020. I think it's dropped since then because people were looking for the quick returns. Many of those big funds, though, they have limits in terms of their ability to go long and short through a whole cycle. They tend to be long only. They tend to only do debt, and I think frankly some of them are probably early, by putting big amounts into some of these distressed Chinese developers. But it's probably, I'm guessing, Michael, around 40 to 50 billion or more. The issue with some of these really large distressed debt funds also is that they have some of them have frankly had style drift and they've become more high yield type lenders. But it's a good question. And great to hear your voice, by the way. It's been a long time.
Yes. Thank you, sir.
Of course. Thank you.
Okay, so I'm going to read the rest of the questions. The rest of the questions that came in, George, what are some mistakes people are making in this space, in distress and event-driven investing?
Well, I guess what I just mentioned is one of them. I think that there's some style drift going on where people just invest in debt, and I think that if you're just buying debt, you have to realize that you're buying it at the peak of a 40+ year bubble, and you're buying it at a time when rates are coming off the bottom of like a 4,000 year low. So I think that could be a big mistake, just being over invested in debt. Another one, just sort of at a high level, is believing that you're smarter than the markets. I think generally, it's possible to be smarter than the markets, but I think that's a temporary condition or a temporary phenomenon. And I think you can take advantage of market inefficiencies, as it were. But you have to be nimble and you have to have good risk management in place to help you manage things that can change suddenly and unexpectedly. And that's some of the stuff we talked about today, like stop loss orders. I think position limits in a portfolio are very important. Prudent use of leverage. I think also, a well-established team approach in selecting securities helps. And limited derivatives, and if you don't believe me about derivatives, just look at the MBIA fiasco. I mean, things like that can blow up any company, no matter how successful and how long-standing it's been. I think those, those are some of the issues that are some of the things people can make mistakes with.
What are the different things that you have to think about when you enter a short versus when you enter a long name?
It's another good question. Maybe the best way to answer that is to talk about some of the factors we look for in a long position, and I can tell you that shorts are all just the opposite. I mean, you want a good industry. You want something that's growing and has, better and better prospects going forward. You want a good management team, and ideally they own their own securities that you're looking at buying. You want companies that have strong and growing cash flows, and you want no litigation or other types of non-commercial debt exposure. I guess with shorts, you want all the opposite things. You want companies where the management team doesn't own any of their securities. You want negative cash flow. You want a terrible outlook for the industry, and you want a bad balance sheet, whether it's commercial debt or litigation type debt. You want something that's unsustainable. And interestingly enough, you can find that in the market. Sometimes I think it's due to human nature. Sometimes equity holders just don't get it, and they stay with situations long after they should have dropped them. And that creates an opportunity for short selling. Then, of course, the last thing with short selling is, you want to be able to get the borrow. You want to work with a good prime brokerage firm, to get the borrow with a deep box at a reasonable price that won't call you in when it's, least expected or least desired. I guess you also have to position it right because, especially lately with things like meme stock rallies, you don't want to be caught, holding the bag and going out of business like we've heard some funds do with shorts that didn't work out well.
This is a good one from someone who's getting to know us more recently. What's your edge?
Good question. I think the edge that our team has is our team to start with. I would say also we've been in business now close to 25 years, and with that we've seen a lot of market cycles. We've seen ups, we've seen downs, we've seen in our investor deck, anybody who wants to take a look at it maybe after this call sometime, we show a timeline that shows all the different sort of horrible market collapses and things that have happened over the several decades we've been in business. I think having experience like that helps. One thing I would also say is, well, maybe a couple of other things I would say. I think having a legal background helps, and we have 3 attorneys on staff at Schulte Asset Management, I'm happy to say. I think looking at investments and having the a legal sort of lens as you peer into their fundamentals, I think definitely gives you an edge. I mean, it's good enough that you have an edge versus investors that aren't doing fundamental analysis, like ETF type buyers or mutual fund buyers that just do it because they want to be in an index. But if you're competing with other fundamental investors, then you also have the legal lens. I think you definitely have an edge, especially in bankruptcy and event-driven investing. And I would say, lastly, I've talked about this a lot over the years, short selling companies into distress before really the big guys start to hunt in those industries and those spaces, I think gives you an early look at lots of the different deals that are out there. And the way we do it is we build our own financial valuation models. We have over 4,000 companies that are in our spreadsheet database. And so pretty much every time there's a new idea that we talk about in our investment committee meetings, we start by pulling it up in the database, and most of the time it's already there. So we're already up to speed. At least we looked at the company maybe it was several quarters ago or several years ago and saw how it was positioned at that time. I think having that experience, as you look at each new investment gives you an edge.
Well, we are at the end of our presentation, and I just want to say that on behalf of all of us at Schultz Asset Management, thank you so much for your time. We are thankful for our investors, for our partners who have gotten to know us and been with us as we grew over the years. We're thrilled to celebrate another successful year of investing together. I encourage you to reach out for a call to talk about any part of the presentation and also to talk about the markets in general. If I don't hear from you, I will reach out to you. We look forward to having this conversation and this continual dialogue. I'm Angela Louie. This is George Schultz. We wish you the very best in your investing and hope to talk to you soon. Bye-bye.
Thank you.